This class is financial management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and adjunct professor of accounting and financial management. For this class, we use the excellent text from Brigham and Davis, Intermediate Financial Management. In this chapter, Chapter 5, we will study financial options. In this chapter, we will cover topics like financial options terminology, option pricing relationships like the Black-Scholes option pricing model and the Binomial option pricing model, and we will also look at a relationship known as put-call parity. Options may be used for many things, such as incentive stock options for CEOs of corporations, hedging portfolios, or speculating for individuals, but they can also be used as an alternative mechanism to value equity. Consider risk-free bonds. You can add a portfolio of stocks and risk-free bonds that replicates the cash flow of options, and that portfolio can be used to value an option, and the value of the option must be the same as the replicating portfolio. What is a financial option? An option is a contract which gives its holder the right, but not the obligation, to buy or sell an asset at some predetermined price within a specified period of time. One of the analogies that can be used is the buyer of the option is the buyer of an insurance product. The seller of the option is the seller of an insurance product. The single most important characteristic of an option is it does not obligate its owner to take any action. It merely gives the owner the right to buy or sell an asset. The seller of the option, that on the short side, is obligated to do whatever the buyer of the option, that on the long side, tells them to do. As a result of this, most of the time, the seller of options makes money and the buyer of options loses money. Just like most of the time, the insurance company makes money and those buying insurance lose money. They are buying the product to lower their risk. They don't expect to make a profit off their car insurance. Now we will start with options terminology. There are two major types of options, call options and put options. Call options are an option to buy a specified number of shares of a security for a set price within some future period. Put options are an option to sell a specified number of shares at a set price within some future time. The strike or exercise price is the price stated in the option contract at which the security can be either bought or sold. The expiration date is the last date the option can be exercised. And again, these are sort of like insurance products. You will pay more for an option that expires in a year than one that expires in 6 months, just like you will pay more for 1-year car insurance than 6 months car insurance. The exercise value is the value you will make off exercising the option. The value of a call option, if it were exercised today, would either be 0 or the current stock price minus the strike price. The value of an option at a given point in time before expiration is that intrinsic value plus a time value. So the exercise value is 0 if the stock price is less than the strike price. The option price, the market price of an option contract, will be above this until the time of expiration due to a time value. The time value is the option price minus the intrinsic value. It is the additional value because the option has a remaining time until it expires, and during that time period, even if it's worth 0 intrinsically today, the stock price could go up, making it more valuable in the future. Alternatively, for a put option, you want prices to drop So the intrinsic value is the strike price minus the stock price. Writing a call option, for every new option there is an investor who writes the option, like the insurance company. A writer creates the contract, sells it to another investor, and must fulfill the option contract if it is exercised. For example, the writer of a call must be prepared to sell a share of stock to the investor who owns the call if they are writing a covered call. If they are writing a naked call and don't own the underlying security, then they would have to pay whatever amount is necessary to buy the underlying security. Writing a naked call is a very risky position because you could potentially lose an infinite amount of money. So a covered option is a call option written against stock held in an investor's portfolio. A naked or uncovered option is an option written without the stock to back it up. An in-the-money call is a call whose strike price is less than the current price of the underlying stock. Similarly, an in-the-money put would be a put whose strike price is greater than the current price of the underlying stock. An out-of-the-money call is a call option whose strike price exceeds the current stock price. The opposite for a put, an out-of-the-money put, would be one whose stock price exceeds its strike price. So the intrinsic value for an in-the-money option is positive, for an out-of-the-money option is 0. And of course, at-the-money call or put would be when the stock price equals the strike price. LEAPs are long-term equity anticipation securities. They are similar to conventional options, but they have longer maturities going up to 2.5 years. We will now look at an example of a call option. Consider the following data. The strike price is $25. So if the stock price is also $25, then the intrinsic value is 0, but our option still has a value of $3. That would be all time value. As the stock price increases, the intrinsic value increases and the call option value increases. Here we have $3 in time value. Here you have 50 minus 25 or $25 in intrinsic value, so you're only left with 50 cents as time value. This is a general rule. As an option becomes more and more in the money, the time value goes down. So if we were to exercise an option, we could figure out the intrinsic value over here. It's whatever the price of the stock is, minus the strike price. 25 minus 25 is 0. 30 minus 25 is 5, and all the way up to 50 minus 25 is 25. This is the value you get by exercising the option. Anything above that is a time value. So now we have the price of the stock in the first column, the strike price in the second column, the exercise value in the third column, and the market price in the final column. So the market price minus the exercise is the time value. We have a time value here of $3. We have a time value here of $7.50 minus 5 or $2.50. We have a time value here of 12 minus 10 are 2. Here we have 21 minus 20 are 1. And here we have 25.50 minus 25 or 50 cents. So as our option becomes more and more in the money, as the intrinsic value goes up, the time value goes down. And we can see that here. Our time value goes down. Here's the exercise value, market price, 25.5 minus 25 is 50 cents, whereas 3 minus 0 is 3. We can graph this out with the stock price on the x-axis, the option value on the y-axis, the exercise value here, which is either 0 or s minus x, and the market price is the curve above. As we go all the way up here, the time value effectively goes away, whereas we have a very large time value when the stock price is the intrinsic value. As you go down, also the time value goes away. So here there's basically no chance of the option being exercised at a positive intrinsic value. Here you're pretty much guaranteed that the option will have an intrinsic value. So in both cases, on the far left and the far right, there is very little uncertainty, so the time value is close to 0. But right at the center, when the stock price equals the strike price, there is a lot of uncertainty about the future, and therefore a high time value. So summarizing, the option time value versus the exercise price, the time value, which is the option price minus the exercise value, declines as the stock price increases. This is due to the declining degree of leverage provided by options as the underlying stock price increases, and the greater loss potential of options at higher option prices. There are two major models that are used to value stock options. One is the binomial option pricing model. The other one is the Black-Scholes option pricing model. We will start with the binomial model. Assumptions in the binomial model. We will say the current price of the stock, P, is $27, and we will consider in the next 6 months 2 possible options. Go up by a factor of 1.41, or go up to a price of 27 times 1.41, go down by a factor of 0.71. These seem like unrealistic assumptions, but when you use this to apply to the actual valuation of an option, you cut down these movements from 6 months to maybe seconds, and then you can build a model based on these kind of assumptions. Other assumptions on the call option: it expires in 6 months or half a year. Its exercise price is $25, so initially the intrinsic value is 27 minus 25 or 2, and the risk-free rate is 6%. The risk-free rate is important because you can always take your money and invest in the risk-free rate versus an option, or you could exercise the option and get the money and invest at the risk-free rate, and these issues will affect the option price. So we start with our current stock price at 27. It could potentially go up to 27 times 1.41, which would be up to 38.07, and this would be at expiration in 6 months. So the payoff would be 38.07 minus 25, or 13.07. The other possibility is the stock price goes down from 27 to 27 times 0.71, or 19.17, in which case it expires out of the money, so our max 0 PD minus X yields 0. Here it's max 0 PU minus X yields the PU minus X of 13.07. We have 2 possibilities in 6 months. The option expires for 13.07 or 0. How the binomial pricing model works is we create a portfolio by writing one option and buying in shares of stock. So the portfolio then has 2 possible payoffs. If the stock price goes up, then we're going to get the up value times the number of shares times the initial price. So the number of shares that we buy times the price per share initially, in this case the 27, times the up, in this case 1.41. That is what we are long because we have bought the stock. We have written a call option, so that's the negative what we have to lose by the payoff from the call option. If the stock goes down, we still have the same number of shares of the stock times the initial price of the stock times the down factor, in this case 27 times 0.71, minus the value of the option that we have written, in this case 0. To create a risk-free portfolio, we set the value of being long in shares of the stock minus the call option value if the stock price goes up, equal to the value of going long in shares of the stock if the stock price goes down, minus the value of the call if the stock price goes down. Since these are the only two options, if we have bought a number of shares such that these two possible outcomes equal each other, then that must be a risk-free investment. We can rearrange this equation as shown here, taking Cu to the other side minus Cd, and taking NSPD to this side, so we get a minus D, and then we solve for NS, and we get, for a risk-free portfolio, the number of shares must equal C up minus C down divided by the stock price times PU minus P down. So we have this equation here. The hedge portfolio with a riskless payoff will invest in this number of shares. Our determined value of the option if the stock price goes up of 13.07 minus the value of the option if the stock goes down of 0 divided by the initial stock price 27 times 1.41 minus 71. So the number of shares we will want to go long for a risk-free portfolio is 0.6915. We can look at the payoff in each of these cases. So if we purchase this number of shares and the stock price goes up, then we get a payoff at the top of $27 times 1.41, the price that it goes up, times NS, which is our 0.6915, to give us a stock payoff of $26.33. The option payoff we determined to be $13.07, so if we have gone long NSPU shares and been paid $26.33, but we've gone short the option, so we have to pay back $13.07. The net value of our portfolio is 26.33 minus 13.07, or $13.26. The other possible future is if the stock goes down, in which case our stock price is going to be PU, which is 27 times D 0.71, which gives us $19.17. The ending value is going to be NS times that, our 0.6915 times 19.17, for a stock value of our portfolio of $13.26. If the stock price goes down, our call option expires worthless, so the net value of our portfolio is again $13.26. In both cases, we end up with a portfolio worth $13.26. Any riskless payoff must earn the risk-free rate, or there will be an arbitrage. Therefore, the value of the portfolio today must be the present value at the risk-free rate of the payoff in 6 months. You can calculate that present value in multiple different ways. Here we show doing it with a financial calculator. So the number of days in 6 months is 0.5 times 365. We were told that our interest rate was 6% per year. Divide that by 365 to get our daily rate. There are no payments, so the payment is 0. We calculate the future value as being 1326. We use our calculator then to get the present value of $12.87. Alternatively, we could just use the simple present value formula, which is probably easier than a financial calculator for something like this. We have present value equals the future value of 1326 divided by 1 plus our daily interest rate of 0.06 divided by 365 to the 365 times 0.5 number of days, which gives us, again, $12.87. Now we can use the relationships we have developed to figure out the value of the call option today. Since the portfolio is riskless, the value of the portfolio has to equal the present value of the riskless payoff. By definition, the value of the portfolio was number of shares times the stock price going long minus the value of the call option going short. So we can rearrange this, solve for the value of the call option, and it then has to equal number of shares, stock price, minus present value of riskless payoff. In our example, this would be NS, which is 0.6915 times the initial price of the stock, which is 27, minus the payoff of 1326, divided by 1 plus the risk-free rate, divided by the number of days per year to get us the risk-free rate per day, then times the number of days, which is 365 times 0.5, since it is a 6-month option. Well, 0.6915 times 27 is 1867. The present value of this is 1287. So the value of our call option today is $5.80. We will go through these kind of calculations in a lot more detail when going through the Hall text and in the chapter there in valuing binomial options. So how about a portfolio replicating the call option? So from the previous slide, we have the value of the call option has to equal the number of shares long times the initial price of the stock minus the payoff, present value thereof. The right side of the equation is the same as creating a portfolio by buying in shares of stock and borrowing an amount equal to the present value of the hedge portfolio's riskless payoff, which must be repaid. The payoffs of the replicating portfolio are the same as the options payoffs. We have shown that the amount of money necessary to borrow to purchase the replicating portfolio is $12.87. In 6 months, when the option expires, the value of that $12.87, if invested at the risk-free rate of 6%, is 12.87 times 1 plus the risk-free rate of 6% divided by 365 to the 365 times 0.5 power are $13.26, the same amount of money necessary as the payoff of the hedge portfolio. If the stock goes up, the value of the stock portfolio is going to be 0.6915, the number of shares we purchase, times the price of the stock if it goes up, 38.07, which we got from 27 times 1.41, are $26.33. If we sold that stock, we would then use that amount of money to pay off what we have borrowed, the $13.26, and then be left with $13.07, which is what we would need to pay off the value of the option. If the stock goes down, then the value of our stock ownings would be 0.6915 times 1917, which we get from our initial stock price of 27 times 0.71. And the value of our stock portfolio is only $13.26, which is the exact amount of money we need to pay off the borrowing for the replicating portfolio. We are left with no money, but we don't need any other money to pay off the option because it's worthless. So notice that the replicating portfolio's payoffs exactly equal those of the option. We can use these examples to look at the possibility of arbitrage. The payoffs of the replicating portfolio exactly equal those of the call option. The cost of the replicating portfolio on day initial is going to equal the number of shares we purchase, 0.6915 times 27 minus the amount borrowed, are 1287. So the value of the option on day zero has to equal $5.80. If the call option's price is not the same as the cost of the replicating portfolio, then there's going to be an arbitrage opportunity. For example, suppose the option sells for $6. We could write the option, receive $6, use that money to purchase the replicating portfolio for $5.80, leaving us with a 20-cent profit. For an arbitrage, you invest none of your money, you have no risk, but yet you make 20 cents. And you can do this over and over and over again, making 20 cents for each exchange. Of course, everybody else wants to make money without taking on any risk, too. So arbitrage will create price equilibriums. If you could make a sure arbitrage profit, you would want to repeat it, and so would everybody else. With so many people trying to write or sell the options, the extra supply would drive the options price down until it reached $5.80, and there were no more arbitrage profits available. The opposite would occur if the option sold for less than $5.80. If you can make a sure arbitrage profit, you would want to repeat it, and so would everybody else. With so many people trying to write, sell options, the extra supply would drive the options price down until it reached $5.80, and there were no more arbitrage profits available. The opposite would occur if the option sold for less than $5.80. These sort of arbitrages and how equilibrium prices are created are discussed in far more detail in my lecture series following the text Hall, Options, Futures, and Derivatives. A simple binomial model that we have looked at, which only has one step into the future, you either go up or you go down in 6 months, is not realistic, but it is a way of understanding how the binomial option pricing model works. If you divided time into smaller periods and allowed the stock price to go up or down each period, you would have a more reasonable outcome of possible stock prices when the option expires. This type of problem can be solved with a binomial lattice using a computer system, and as time periods get smaller and smaller, the binomial option price converges to the Black-Scholes price, which we will discuss in later slides. We will continue with this lecture series in the next video, starting with the Black-Scholes option pricing model. I thank you for watching this video.